Good day to all our listeners. It's really exciting to have everyone back. Today we have one of our first 2025 CFO podcasts, and we've got a special guest with us here today in studio, Roger Castle, and it's really an honor and a privilege for me to welcome Roger. Little bit of background: Roger is an accomplished ACMA qualified finance professional, and he's got extensive and great experience as a VP in finance, finance director, and a CFO across a wide area and sectors. If we look at cloud management, hosting, online advertising, financial services, and telecommunication, and he's an expert in leading finance operation in complex organization, and he's got a real niche in strategy development, business goals delivery, and building a motivated and collaborative team. Roger, thank you so much for joining us today on our podcast. We're really excited to spend some time with you. And today we really want to chat a little bit about strategy. CFOs, management, board of directors, people sometimes sit around a table and come up with this brilliant, amazing vision for an organization and build their strategy around it. But at the end of the day, your strategy really needs to engage your stakeholders. And I think more importantly, you need to get the buy in of your team. So, if you can just introduce yourself a bit to our listeners and then maybe share with us your approach to creating a vision for an organization that is really inspiring your team and that's going to gain the trust of the key stakeholders in the organization.
Hi, Leana. Thanks for the intro. I think really, I think what we say at CFO Centre, it's about magic numbers. So it's really establishing with the business where it wants to get to. What's its ideal outcome from engaging with us? Is that grow and exit? Is it employing more family or community? Is it about higher dividends, be that for family or for management or for employees? It might be about creating a new innovative product. It might be breaking into a new market or a new geography. It might be relaunching an old product that's been decommissioned. Sometimes it might be even as simple as attaining cash flow positivity. You know, that's the thing that keeps CEOs awake at night in many of the companies that we engage with initially, and we get beyond that stage to the growth stage. So it's sitting down and asking where they as a management team want to go. I think in my experience, most businesses have a reasonably good notion of where they want to go, certainly at the CEO level, but they've not really laid it down. They've not put it into numbers. They've not developed a formal business plan or strategy document, and they certainly haven't established what important key performance indicators there are within the business that would deliver those numbers. So most commonly it's grow and exit. So I think first of all we need to establish there what EBITDA profitability the company needs to get at the expected valuation multiple at exit to achieve the valuation that it needs. And how do we work with the management team to achieve that number? So it's about what products, in what markets, with what volumes, with what selling and marketing costs, in what timeframes are we going to use to get to that magic number that gives the right exit number. My advice on that front is getting the management team together collaboratively to agree these financial and non-financial targets. Make sure they agree on the right outcomes, make sure that they feel that they're realistic and that they can deliver them, because otherwise the whole thing falls apart. And make sure that all members of the management team are aware of what targets there are, that they cascade them to their own teams and hold accountability to those numbers. Next, I think the next stage from that really, Leana, is about providing the right incentives to staff to deliver that strategy. So is that a bonus program over a few years? Is that a shareholding in the company? What is it that aligns management and the staff within their departments with the CEO around achieving those goals? If it's a project, if it's a new product, a relaunch or a new market, can we prove out through good financial analysis that the payback opportunity is really there, taking all risks into account? And I think one of the strengths of CFO Centre is that we have a community of 400 or so CFOs in the UK, and then many more internationally, plus our marketing, selling, legal contacts, etc. Um, and we can use that experience without breaching client confidentiality to de-risk some of those plans into new markets. So we might be able to find out what a typical margin is, what typical pricing is in a market, and what typical routes to market might be used, and how quick the build patterns are, etc., etc. So I think those are the key issues really on that one, Leana.
Thank you so much, Roger. I hear that you're referring to obviously targets and accountability and putting in the right incentives for these teams and the team members and the staff. Do you find in the corporate environment, I've literally just was thinking about it when you said that, do you find a lot of, I don't want to say pushback, but that does it happen often that an organization or team members in an organization don't buy into a strategy or are reluctant or resistant? You know, we always say accountants, the typical accountant don't like change. And a lot of times, visionary strategy brings change in an organization. Do you find a lot of resistance in general in the corporate atmosphere, or people in general really let's do this and let's get this done? And if you find that resistance, how do CFO and the CEO counter that? Do you find that bonus programs, incentives usually sway the mind and the feel of these guys?
It very much depends on the culture of the company. Most of the businesses that we engage with are pretty positive about growth and will have fairly positive management teams. So it's about target setting is always a little bit about negotiation. So, if you ask the sales director what's he going to sell in the next year, he'll generally pitch a low number, and then you talk him up. But you can use market intelligence to challenge that number. You can look at competitors, either numbers that are published through public companies or through our colleagues. You can see what growth rates typically are in that same market and challenge back to the sales lead on that number, and then arrive at a reasonable target using data points in the marketplace. And then I think really, understanding from top to bottom what the payback is for staff, be they management or rank and file staff, understanding what their payback is in terms of bonuses, shares, etc., is a very good way of aligning people around that market. For sure, they'll go that extra mile if they've got an incentive to do so. In some cases, if you've got long-standing dissenters who won't come with the strategy, I've had an example of a sales director who just wouldn't accept a sales target, and in the end, we had to manage that individual out of the business and replace with somebody that was of a positive mindset. But there are various angles to tackle that one with, I think.
It's a it's great for me to hear you talking about the culture of an organization, because I think a lot of time management, staff, every level, all the stakeholders of an organization don't recognize always the importance and how a culture plays into the success, the growth, and the strategy of a business. So it's great to hear that from somebody with all of your experience. Roger, can you maybe share with us a time in your career, in your lifetime, when strategic vision played a key role in driving a company's growth? What made it successful? How was that strategic vision and goals linked directly to the success and the growth of that organization?
Sure, no problem, Leanna. Yeah, obviously won't talk individual client names because we always like to be confidential about what we do. But I've been working with a manufacturing client now for 7 years or so. In the first month, we had 100k pounds worth of turnover. And the owner of the business really wants to grow that business and exit, and we're already trading well above £500,000 a month now, which is really great. And I don't claim all of the credit for that, but certainly we set ambitious targets over rolling 3-year patterns to get to the numbers that we wanted to build a turnover number, a profitability number that would, at the expected valuation multiple that we've got, give a good exit value to the owner. The owner's motivated really by so he's mass manufacturing his product at the moment. What he wants to do is more bespoke product longer term. So that's his real kind of incentive to exit the business that he's in today. So really, what we did was we created annual growth targets, and we boiled those down into key performance indicators that we could share with people on the factory floor. So they understood each and every month, in fact, more so each and every week or day, what volume of units they had to produce to meet the target. So that it wasn't some kind of abstract financial target, it was something tangible that they could produce every day, every week, every month to help deliver the targets of the business. In doing so, we also gave everybody top to bottom a view of how they would be bonus based on the achievement of those targets. So we have a budget number, we have a budget plus number, and then we have a real stretch target number, which pays them an increasing percentage of that bonus number as they out-achieve the budget. And that's worked very effectively. We've also done some work around, a lot of the early stage sales growth came from personal recommendations, one client recommending to another. But at some stage, that starts to run dry as a channel to market. So we've used some of our colleagues on the marketing side, the marketing centre. So we've identified LinkedIn communities around architects, project managers, etc., in the construction industry that would be interested in the product, and then we've put out interesting content to gain business through those, and that's helped as a channel to market. So it's not just a pure financial exercise, it's saying what are the distribution mechanisms that we can achieve in the market through working with colleagues that will push sales growth to a new level. What we also do is we have a monthly meeting. So I prepare a deck based on achievement of the numbers against target, and where we need to go in the next month and quarter. And the CEO stands up and goes through that with the whole company once a month, so they know exactly where they are against those targets, and what needs to be done to recover, or what can additionally be done to capitalize on those targets if there's outperformance. So I think it's it's been a very satisfying journey with that client of growth, and we're really getting to where we need to be. And I think that's all about setting realistic targets, communicating regularly, and getting everybody involved in the delivery of those targets.
Sure, Roger. 100,000 to 500,000 is quite a amazing, brilliant growth. Congratulations to you and your team and the organization there. I think what was also important for me there is that you mentioned, I think you've been with them, helping them for 7 years. And I think sometimes we lose sight of the time frame, that it's not going to happen overnight. There's a lot of things that needs to happen. And obviously, when you have this strategy, you need to implement it. And sometimes along the way, we were talking about strategy the other day, you have to change the plan. Something that you planned and that was an expectation is for some reason not going to happen anymore. So it's a live document or a live plan that can change at any point in time. You did mention that this example that the CEO stands up and have monthly meetings. What do you think is the best way and approach for the management team to make sure every department, from finance, operations, marketing, and every employee, I mean, your support staff, your warehouse staff, your marketing staff, understands and support the strategic goals? Is there different approaches that people are following in practice, like this way? You said this individual have monthly meetings, I'm assuming with the whole organization. Do you leave it to the department heads to filter the message through? In your experience, what is the most efficient? And I always say that people just want to belong. So even if your your receptionist, which is the face of your organization, understands the strategy. It's very important. But who shares the message with the receptionist? In your experience, what would you advise people to stay away from? The typical email, sales will grow with 50% in the next month, or does that work? Or in your experience, if you can just share some ideas with us, please, Roger.
Sure. Yeah. No, I think really the personal touch is really important. So I think getting everybody together so they feel togetherness as a team across the whole company is important. But it's also important that they get the message from the people that they touch on a daily basis, so the departmental heads and so on. And I think the messages around targets, you can't communicate too often really, because it needs to be top of mind for people the whole time. So I think, probably having monthly or quarterly all hands with the entire company from the management team to get the message across is good. But I also think that engagement in monthly departmental meetings where they're talking to the person that they engage with all the time is very important in making sure that everybody is aligned on the same number.
Great. Roger, now I've been thinking while I was talking to you, and I mean, this is not something that I thought I'd bring up today, but I was just thinking, if you walk into an organization that doesn't have a clear strategy, because I'm going to abuse your expertise now while I've got you on the call. Where do you start with the team? I mean, do you look at what they've done previously? Do you say, right, guys, where do you want to grow? You mentioned at the beginning of our call, sometimes people want to grow the business, sometimes they want to expand, sometimes they just want to maintain cash flow. Of course, there's different reasons and different strategies. But if you find yourself in an organization that doesn't have a clear plan, doesn't have a clear strategy, I'm assuming it's not something that you've got a 2-hour quick board meeting or management meeting and there you've got a strategy. If you can maybe share with us, like practically, where do you start? Do you look at the history? Do you look at first where you want to go? Like really putting it practical for our members, for the guys out there. That is because I find it happen a lot, especially in South Africa. We've got family owned businesses. It started off as a medium small family owned business, and this business is just so successful and becomes a beast. And at one point the owner and the family wakes up and said, but where to from now? We started this business to earn an income, create some job opportunities, but now we need to plan where we're going with it. And a lot of times these guys don't know where to start. A little bit of guidance from you on that, please, Roger.
Yeah, no problem, Leana. Yeah, I think it's clearly, as you said, it's looking at past trends. So what have the growth numbers been historically? But then also putting that in the context of the market. So what would a similar sized company expect to be growing at in this market based on what we can ascertain, as I said, from publicly filed information or through our network of contacts within the industries. So looking at market comparisons and providing a challenge based on that. So if the market growth rate is ahead of the past trend, challenging the team to say, why can't we meet that number? And then introducing our new ideas around what can we do different, because we won't get a higher growth rate just by doing the same thing. So do we need more sales resource? Do we need a sales team at all? Maybe we haven't got one. Maybe we've just, like with my manufacturing client, maybe we've just sold on recommendation historically. What could we do extra with the sales team? What could we do extra with more marketing? Do we need to look at the pricing policy for the product? Could we sell more by reducing the margin somewhat and being more price competitive? It's trends within the market in the company itself. How can we push those to a different level? And then kind of marrying that up with if it's a grow and exit scenario, which typically it is, what is that magic end number that will give the valuation that the CEO and the management team wants? And how does that compare to what we're seeing if we adjust the past trend for the market comparison and what we achieve extra by using different channels to market, using more selling, more marketing? Will that get us to the exit value that we want? And if it will, then those are a sensible set of targets, and then break those down at an individual level. So how many sales do we need? How many pricing situations do we need to be involved in? Therefore, how many sales leads do we need that will lead to pricing pitches? How many marketing leads do we need ahead of that will lead to those sales leads? How can we give each of the departments a set of targets that will align with that end sales number that would deliver the magic end number for the exit valuation?
Roger, I definitely think we need to have a follow-up podcast with you on exit strategies. I was talking to somebody the other day, which has got this very, very successful, big family-owned business, and they started it many years ago. The gentleman is in his late 60s, and he doesn't know how to exit this business because his children is not interested. They followed own different careers, very successful in their own right, and he's got this emotional attachment to this business, and it's a big business, so it's not something you're going to just sell to anyone. And they're now toying with the idea, should they list it and go public to exit, should he sell it to private equity? So I think exit strategies, with you mentioning this, is definitely something that we should please explore in the future. Roger, with the strategies, how do you deal with and handle the tension and the relationship between meeting short-term financial targets and achieving long-term goals? I was talking to somebody the other day that's in business. It's actually the FD of an organization, and he says he's got such a challenging position. He's got clients and his sales team are really trying to push the sales prices to meet their selling targets, but he knows if they can meet the client maybe a little bit halfway, it might extend to bigger orders, bigger projects, bigger contracts in the future. So obviously he's willing to maybe cut a little bit now, for the long-term goals and objective, but then there's the short-term goals, of immediate satisfaction, immediate profit, and results now. So, how do you balance that act about short term financial targets and then achieving the long term goals?
Sure, yeah. I think it's about being pragmatic, Leana. So, yeah, if sales are down or not at the rate we need them to be, certainly there's an argument to be, or a discussion to be had around reducing margin, assuming that margin is there. So maybe target, if it's a big new client that can lead to great things, it's a small initial project. Maybe that we price that one down to get a foot in the door at that client to gain trust, and then we sell other ancillary services at a higher margin, or follow on business at a much higher margin. Um, I think it's about realizing early on that you've got an issue. So, is your KPI that leads your end number, if that's, sales opportunities, if that's marketing leads or whatever, if that is not at the level it needs to be, that you address it today, not when you see the end result of that 2 or 3 months down the line in poor turnover numbers or poor margin numbers. So it's about having those milestones that will identify early on if you've got a problem, and reacting to them. Clearly what we never want to do is harm the long-term prospects of the business. So sometimes, if we've got failing profitability today, we might, and we can't address it from a sales angle, we might be tempted to cut heads, but that could lead to a lack of sales if we cut sales department, or a lack of capacity if we cut the manufacturing department, which means we can't achieve our targets further down the line. So it's got to be that right balance. It's got to be an engaged discussion with the management team on how we recover back to the target and how we don't harm the business long term. So I think it's about that discussion amongst the management team. It's about adjusting quickly, and not adjusting too aggressively short term that will harm the long term prospects of the business. And then once you've agreed that slightly revised version of the plan, making sure that's then communicated in an all hands meeting or departmental meeting so that everybody's on one page. It might simply just be that we've had a poor month or a poor quarter, but actually, if you look at the trend lines, if you extrapolate the trend lines, we're on track to be where we need to be, and therefore we don't need to overreact in the short term. So it's very much looking at the numbers, having the discussion as a management team, seeing where we are relative to the long term, and then making, as a management team, making the best adjustments that we can to lead us back towards that end result that we're looking for.
Like they say, the numbers never lie.
Yeah. Well, that's the beauty of finance, right? There's lots of opinion in businesses, but the numbers are the numbers, and they hold a certain truth. And if you use them in that proactive way, if you look at leading indicators, you'll know you've got problem ahead, and it's not always negative. It might be that you've got outperformance on the number, and if you've got some outperformance in the last quarter, and you double the size of the marketing spend, or you put an extra person in the sales team, you could get that outperformance number, which drives bonus plus for the team, which is happy all round. Us CFOs, we don't mind getting our checkbooks out. Not that we have checkbooks these days, but we don't mind getting them out for over performance, because the numbers are good if that happens.
It sounds like it's a bit of a balancing act and just getting that sweet spot. And like you said, not overreacting or underreacting. I think sometimes we also lose a little bit of sight in, like you said, it might be a period. I mean, a lot of businesses have got certain periods of the year that is a bit of a slowdown. But historically, the next quarter or the next 6 months or the next half year is going to pick up and just turn that results around for you. And if you make the wrong decision now, you can pay some school fees for that in the next 6 months. Roger, while you were talking about adapting and making changes, sometimes unexpected challenges happens. The market change, the market shift. I think um, we always bring up COVID because I think it was something that none of us expected, and we've learned so many hard lessons from it. So, when these challenges come up, or the market changes, or something happens in life or in the market, how do you adjust your strategy, your vision, without losing the momentum? And then I think more importantly for me is the trust in the stakeholders. So something can happen, and you obviously need to react, but in such a way that you're not going to lose trust of your stakeholders. And I think for me, important there, it's shareholders, but also other stakeholders, like employees. I mean, we've seen in South Africa now, it's been in the news a couple of times about two big organizations that's actually going to do um, layoffs of staff, and it's really bringing so much uncertainty. And it's because of things that happened in the market and in the industry that those businesses operate. So, how do you react? How do you adjust your strategy, vision when these unexpected, which the experts are now saying we must be ready and agile and prepared for the unexpected, but it still happens?
Yeah. No, it's interesting you mentioned COVID, Leana, because I've got a prime example of that. So I worked with a PPE company. I didn't even understand what PPE was as an abbreviation when I started, because it was pre the pandemic. But of course now it's a household term. But clearly it created a high short-term demand for that client. So they basically did a year's turnover in one quarter. But it was quite key to make sure the business understood all the dynamics, particularly including cash flow, because they had a huge demand for their product, but they couldn't get the supply. Everybody was obviously buying it. So they were dealing with new suppliers, often on demanding upfront terms, payment upfront of delivery, and then selling to their usual clients on the usual 30-day terms, which clearly creates a cash flow discrepancy. So we really had to understand, you had a procurement director that was buying as much as they could, and a sales director that was selling as much as they could. And the combination of the time lag between paying suppliers up front and being paid by customers 30 days plus, was a cash flow challenge for the business. So it's about making sure all members of the management team are on one page. So in that case, where we wouldn't normally have shared the cash flow forecast with the sales and the procurement director, we did, because there was danger within that number, and the CEO was being kept awake at night by worrying about running out of cash, even though there was huge opportunity in the market. So I think it's about allowing the business to do as much business as makes commercial sense. So that might be proving out the margin on new business, that and understanding where we can go on pricing to make winning deals. But it might also be just simply understanding the cash flow impact of the business they're about to transact, and making sure either we don't put the business into negative cash flow, or we make sure we work proactively with the bank to increase the overdraft limit, or to get other lending facilities that allow us to do that level of business. Um, so I think, and in more general terms, as I said, my philosophy has always been to let the business do as much business from a selling perspective as makes sense to the business commercially. There's no way you want to be the CFO that's saying no to everything. That really doesn't help anybody. Conversely, you don't want to be being the endlessly nice CFO that signs off everything and puts the company in cash flow problems. So I think it's about working with deal models for your business. So understanding what gross margin you anticipate to make from product sales, and then going back after the sale and say, look, bearing in mind how much we anticipated from raw materials, manpower, machinery, space, etc., how much we actually did consume, is our deal model right? So are we leaving money on the table because our costs are less than we think they are, and we could price down a bit to sell more, or in fact have we underestimated the costs in our deal model and we need to recover more of that, and maybe we need a price rise or whatever. So I think there's lots of ways to tackle that one, but for sure, as always, it involves engaging with the management team to understand the dynamics in the business and understand their impact on those, Leana.
I like the reference about the deal model and the cost. It's Roger. Many years ago, I was talking to a client, and they had obviously a set and expected GP, and they sort of missed it some months, not by a lot, but something wasn't looking great. And we did a little bit of analytics and investigation for them, and it came out that they have one product which they make a terrible margin on.
Mm-hmm.
It's almost negative some months, and then all their other products are such good sellers and they make decent margins on it, but it brings the total organization margin so much down, this one product. And I think it was a pure, and they've been going on with that for 2 or 3 years without really realizing we're putting all this effort on this one product, and which either we need to cut costs in some way for that product or increase the selling price, which wasn't viable at that point in time. And cutting that product out just gave them so much availability of staff and resources, cash flow, that they could focus more on the products which they didn't think was, I don't want to say they're best sellers, but they didn't realize these are actually the guys that's carrying the business. And it's, I don't want to say a simple exercise, but just something like that, to look at your product mix, what is the cost of it, and how does it impact the business overall. And if you look at them individually, it's a bit of an eye opener.
Yeah,
Um, yeah.
I agree. I think mix is really important. There's a place for a low margin product.
Yeah.
If it if it leads to, if it's something that becomes higher margin through scaling the business,
Mm.
because you've got a machine that's underutilized or staff that's underutilized, that's fine. As long as you understand the long term growth pattern for that product and you can achieve the margin, that's fine. It might be a product that gets the foot in the door to other higher margin products, as you said, and it might be that commercially you can structure the selling process around combinations of products, so you only sell the low margin product with the high margin product, and in the mix the margin is fine. Another way I've seen to address that, work with a portfolio of products with very different margins. We would actually pay the salespeople more commission as a percentage on the higher margin product as to the lower margin product, to try and influence the distribution of that mix amongst from the lower margin to the higher margin products.
Such a good approach. Roger, I wished when I studied you were there to be my financial manager lecturer because for the first time in life I'm understanding product mixes much, much better. Thank you so much for that.
No problem.
Um, Roger, one piece of advice that you can give CFOs on how to use communication to get stakeholders fully on board with this strategy and the vision. I mean, we've touched on this today, but any last thoughts, piece of advice on communicating and sharing your strategy with all the stakeholders?
Yeah, I don't think there's any one thing. I'm just going to use it as the opportunity to summarize. So, um, for sure, the first thing is get the management team involved in the vision, in setting the targets, in understanding the targets, and selling it to their teams, and then make sure that that management team and their staff understand how it benefits each and every one. Get that engagement, get that alignment, get everybody on one page, and then time and time again it will work. The second thing is providing those regular updates, so the team meetings, the all hands, very important to do that on a personal level. You can back it up with emails and so on, but the personal engagement and contact is absolutely critical. And making sure that you identify those leading indicators for the financials, so the sales leads, the production numbers, the resource, the inventory levels, etc. Have you got the right leading numbers to deliver tomorrow's number, and concentrating on that? And then, the last thing I'd say is adjust quickly. So understand where those shortfalls or over performances are occurring, and adjust the strategy to recover them, or to capitalize on them. Don't be afraid to recognize as a management team that you've got it wrong and you need to adjust, but do that quickly. And in my experience, you will generally always get success from that formula.
I wrote an article this week for our blog for our CFOClub, Roger, and it was about uh, feel in an organization of excuses, that they say how this really brings a team down. So I really like that you say, if you got it wrong, admit you got it wrong and adjust and react quickly. And what are we going to do to get it back on track? Roger, we always ask our CFO club and our members and the guys that we interview if a recommendation on any book that you have found useful in your life, that you always look back and say, when I read that, it really made a difference in my life. It can be professional, personal. I'm currently reading a book called The Let Them Theory by Mel Robbins, um, which is an eye opener. So yeah, any book that you would like to recommend to our readers, something that really changed the way you look at business, do business, or the way you just approach things in life?
Do you know, not a book as such. I'm not a huge reader of books, but I've consistently subscribed to The Economist through right from school. Actually, we're doing A-level economics at school, right to now. And I use that to kind of keep abreast of what's going on in the marketplace, understanding what business trends are at a macro and a micro level, and understanding those key developments. It's a good, it's probably an hour's read once a week. Read it on the train, read it when you've got 5 minutes. It's just, but it's written for me as not a person that really enjoys reading 200 or 300-page books. It's very snappy, and it keeps me current, and I always learn a lot from that. So that would be my recommendation, Leana.
Thank you so much, Roger. That's it's great to hear that there's different options. And for our listeners out there, The Economist, that is Roger's guide to every week, to just keep him up to date and with this amazing skill that he have. Roger, thank you so much for joining us today at the CFO Club for this podcast. We really appreciate all your knowledge and your skills and your experience that you've shared with us. Some great golden nuggets today for our listeners to take away. And I'm sure we're going to definitely chat to you again. I'm going to hunt you down for that exit strategy and exit plan podcast sometime in the future. And once again, thank you for joining and have a lovely day.
No problem, and my pleasure. You too.
You have done the work. You have earned the title. now get the designation. Cyber's most sought after CFO SA designation gives you the credibility and objective recognition of the 34 competencies that you've mastered on your route to becoming a CFO. Cyber's most sought after CFO designation gave me the credibility and objective recognition of the 34 competencies that I have mastered on my route. It's grounded in an internationally recognized competency framework requiring knowledge and experience in strategy, operations, and finance. Being part of the CFOClub Africa opens you up to a network of CFOs. The CFO SA designation is relevant to you if you have experience in performing various finance executive functions within the finance department. Being part of this elite group of modern CFOs helps you grow alongside your peers in a valuable source of advice on leadership challenges. If you are looking to demonstrate your leadership abilities to the future employers, then this designation is for you. Apply now. It's time to step it up. Become a finance leader and get recognized as a CFO. This is your Cyber.